Ladies and gentlemen, good day and welcome to Kaynes Technology India Limited Q4 FY24 earnings conference call hosted by JM Financial Security Limited. As a reminder, all participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Agarwal. Thank you and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of JM Financial Security Limited, I welcome you all to Kaynes Technology India Limited Q4 FY24 earnings conference call. Today, we have with us senior management represented by Mr. Ramesh Kannan, Founder and Managing Director, Mrs. Savitha Ramesh, Chairperson, Mr. Jairam Sampath, Whole-time Director and Chief Financial Officer, and Mr. Rajesh Sharma, CEO. Without taking much of the time, I would like to hand over the floor to the management.
Good afternoon, everyone. On behalf of Kaynes Technology team, I would like to welcome everyone to the earnings call for Q4 FY24. I have along with me Mrs. Savitha Ramesh, Chairperson of our board, Jairam Sampath, Whole-time Director and CFO, Mr. Rajesh Sharma, CEO, Mr. Sumit Verma, Investor Relationship, and Orient Capital, our investor relations partner. I would like to take this opportunity to express our heartfelt gratitude to each and every one of esteemed investors for the encouragement provided to us during our journey so far. I am happy to inform you that we have been able to achieve a revenue of 18,046 million during the financial year 2024, which represents a strong growth of 60% year-on-year. The operational EBITDA margin for the financial year FY24 was at 14.1%. The profit after tax for the financial year 2024 was at 1,833 million and the PAT margin was at 10.2%, which represents a growth of 93% year-on-year. Coming to our performance for the quarter end, March 31st, 2024, our total revenue was rupees 6,373 million, registering a growth of 75% year-on-year. Our Q4 FY 2024 operational EBITDA was 952 million, registering a growth of 60% year-on-year, with an operational EBITDA margin of 14.9% for the Q4 FY 2024. Our growth was led by strong demand across all the verticals, more notably industrial and EV, aerospace, outer space, and strategic electronics and railway verticals. We continue to witness strong demand across verticals. The order book sells from rupees 37,890 million at the end of Q3 FY24 to 41,152 million at the end of Q4 FY24. The average order inflow per month increased from 2,788 million per month in Q3 FY24 to 3,212 million during Q4 FY 2023. On the operational efficiencies, we have made consistent effort to improve improving the working capital cycle, and I am pleased to inform you that the working capital cycle has reduced to 83 days in FY24 from 99 days in FY23. We expect further improvement going forward with sustained action on this front too. On business side, we have consistently been working to strengthen our company to become an integrated EMS company, which was to serve a higher value share of customer requirements. Towards this goal, we have to incorporate a new subsidiary in the mechatronics area that will focus on new generation of plastics, metal enclosure, and also the molds, tools and fixtures. We have a very strong traction in the high performance computing server manufacturing, where we have won a large order from CDAC. We also have more proposals which are coming to fruition in the areas too. We have also received a substantially large order in the aerospace, outer space and strategic vertical that would improve substantially our overall revenue portfolio during the years to come in. In the medical electronics area, I am pleased to inform you that we have concluded a contract with a large medical equipment company for both domestic and export area. In the industrial and EV vertical, we have received a breakthrough contract from a smart meter company which will substantially augment our business portfolio. In railway electronics area, in addition to electronics interlocking, we are working specifically in projects onboard electronics, train collision avoidance system. Going forward into the future, these will further augment our valuable portfolio of business. We are very optimistic going forward for your revenue growth, expanding into other key verticals, and will not only improve top line but bottom line as well. For the year 2025, we expect to cross a similar rate of growth in revenue greater than 60% and an improvement in operational EBITDA margin of more than 100 basis points. Kaynes continues to invest in new initiatives and executing projects in newer, higher potential segments. These strategic initiatives are posed to strengthen the company's competitive edge and make Kaynes an integrated EMS company. Many new initiatives are in the planning phase to support this strategy. We continue to expand capabilities across verticals with clear focus on outlined strategy of continuous expansion of customer base, with focus on large accounts with growing share of value-added services. Semicon assembly, also called as OSAT, and high-density interconnection PCB projects are critical to our business strategy of being an integrated player. We are in the final stages of obtaining government approvals for our new investments and expected the approval soon after the model code of conduct is concluded. We feel even there is a delay of 2-3 months, we will be well within the expected plan, and we will catch up with the timelines for these projects implementation through preparatory steps which are already underway. Thank you all once again, and we look forward to exciting times ahead. I will now hand over the call to Jairam Sampath to take you through our financial performance Thank you.
Thank you, Rameshji. Already, I think a lot of financials have been studied. We have also published. First of all, thank you for joining the call today. I'm very excited to share Kaynes Technologies' financial results for the period ending March 24. For the quarter ended 31st March 2024, our consolidated total revenue was INR 6,373 million, representing a 74.8% year-on-year growth. For the 12 months ended December 24, the consolidated total revenues was INR 18,046 million, representing 60.3% year-on-year growth. The consolidated EBITDA for the quarter was INR 952 million, showing a 60.5% year-on-year increase, while for the year, it was INR 2,542 million, which was up 51%. The EBITDA margin for the quarter and for the full year stood at 14.9% and 14.1% respectively. Our consolidated profit after tax for the quarter was INR 813 million, up 96.8%, and for the year was 1,833 million, up 92.5% year-on-year. And PAT margin for the quarter stood at 12.8%, and for the 12 months it was 10.2% respectively. 41,152 million rupees. Net working capital at the end of March was 83 days on an annualized basis, lower than 99 days for the previous year. Our inventory was a tad higher as we have to make advanced purchases keeping in mind the requirements of upcoming quarters. Our net debt at the end of the quarter adjusted for unutilized proceeds was INR 2,177 million compared to INR 473 million at the end of March quarter of FY23. Our ROE and ROC adjusted for unutilized portion of proceeds is at 22.8% and 22% respectively for FY24. We continue to make serious progress in our expansion and continuously adding newer lines across various facilities, especially Chamarajanagar, which is in line to become truly integrated facility. Our Pune facility, which was acquired recently, is also now operational. Also, we have planned to expand the new regions in India and outside India as well. All these expansions will help the company ramp up its production significantly over the coming quarters. On OSAT, we have provided Government of India with all the requisite details and hopeful of the positive outcome soon after the elections. We have also started preliminary construction work in Telangana and hopeful of meeting the desired timelines for the same. We will be sharing final details as we make further progress on the same. We look forward to your continued support on this journey ahead. With this, I would request all the participants to come in with their questions. I now open the floor for questions. Over to you, Deepak.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Good morning, gentlemen, and many congratulations on very, very good performance that you've delivered in the fourth quarter. I've got questions. First, I will talk about the financial question that I've got. I just need some clarity over here. One, the gross margin is something which is very important in this particular business. If we see the last couple of years, this number used to be hovering, closer to 34 and then, stabilize at around 30%. This year, we've seen that number drop to about 26%. How do you see the gross margin in the next couple of years? And this is very important given that you are looking for 100 basis point expansion in the EBITDA margin. So that's the first question on the financial gross margin.
Thank you, Rahulji. A pleasure as always to interact with you on the calls. So the gross margin is a blended gross margin, which is a function of relative contributions by different industry verticals. As you know, our maximum contribution is coming from automotive and industrial and EV sectors, which is almost close between 60 to 70%. And these are what we call the high volume sectors. And the gross margins in these sectors are somewhat lower compared to the aerospace vertical, railway vertical, medical, etc. And so this year, we have seen the orders for the financial year FY25, and we find that the portfolio balance is coming back to our original expectation, which is like 60-40, and maybe eventually it will be 50-50. So 50 of high volume and 50 of high profit making products will be there in our portfolio. So what started at around 15.5-16% came down to say 14% last year. This year we expect it to go up beyond 15%. So this is a kind of a cyclical phenomenon. And then overall average it will be about 15% EBITDA, operational EBITDA.
And I think you also talked about, you will have a lower tax rate for some time. How many years will you have that 20% tax rate?
Yeah, this is 17% for the Kaynes facility, which is registered under 115BAB. It is lifetime.
Okay. So the blended tax rate should be in this range only. Hello?
The management line got dropped. Stay connected until we connect the management back.
Yeah. Can we have the next question, please?
The management line has been connected.
Hello?
Yeah. Please go ahead.
So you're basically saying that your blended tax rate will be in this range only, around 20-21%.
Sorry, blended tax rate? Yeah. It will be nearer to this number. Yes.
Yeah. So my second question is on, you in your opening remarks, you talked about manufacturing, basically augmenting your manufacturing facilities. You also talked about having overseas manufacturing facility. Can you just throw some light? What are your plans on that front, please?
Yeah. So in overseas, we have done an acquisition called Digicom Electronics, which is primarily a player in the low volume and, let's say, prototyping work. And these are the clients which have high volume requirements too. And so our plan is to leverage our presence in the US and get high volume business for our Indian facility. So we do a dual tandem act. So we are very close to them. So we do their prototyping, new product development sitting in the US. And when it comes to volume production, we do it in India. So we have already received several customer confirmations who are from the customers who are in the US to use this kind of a methodology so that they get good service like a near shore company, and they also get good cost like a India kind of cost.
Sure. Thank you very much, and all the very best, sir.
Thank you, Rahulji. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we will request you to rejoin the queue. The next question is from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
Sir, thank you for the opportunity and congratulations on a great set of numbers. So my first question is regarding your order book of about 41 billion. Possible to give us some sense of the segmental split of the order book that we have right now?
Yeah, the segmental split of the order book is similar to what we have on our sales numbers for FY24. One notable improvement that is there is that earlier we used to get orders up to 2 to 3 years. Today we have orders which are spanning up to 5 to 10 years, especially in the aerospace and other sectors. So split will be very similar to our business profile. Maybe the high volume orders get placed not for the long term, so they come in during the year, and the order will be predominantly the things like low volume, high tech, high margin. Those kinds of orders will be predominantly in this particular order book. So yeah, it is similar to what we have in FY24.
Understood. And so secondly, possible to give us a broader sense of the segmental margins, because you have the highest operating margins versus all other EMS players presently. So possible to give us a renewed sense of the segmental margins and also your capex guidance for 25.
Yeah. So Mikey, first I will take the second question first. So we have always been working towards making our company self-sufficient as far as funding the 60% growth with capex which is generated out of our operating cash flows. So I'm happy to tell you that this year we made a small beginning, and we made a small quantum of operating cash flows, positive operating cash flows. And in FY25 we will certainly do an OCF by EBITDA of more than about 50-60%. So which with 60% growth on the numbers, I think it will and something like 100%, 100 basis point improvement in the EBITDA. So it will give over 200 to 250 crores of money which can be invested into capex, and that will be sufficient, taking a 7 or 8 times asset turnover eventually. So that will be enough to do the growth for sales revenues in the EMS sector. Now the segmental profits, we normally, there is a customer confidentiality and all this, so we don't talk about segmental profits.
Yeah. So the segmental profit we don't report, but I can give you a broad guidance in terms of ranking. So let's take high volume sectors by the name of, let's say, something like automotive, industrial, and EV. They are in terms of material costs, lower margins. But in our assessment of the manufacturing costs, which are significantly lower in these high volume products, in terms of EBITDA, they are not very different. Of course, the high-tech sectors and low to medium volume sectors like aerospace, outer space, defense, railway, electronics, medical, etc., they are decidedly having a high gross margin at raw material level. They all have their own importance in our portfolio. The high volume customers give us ability to purchase large volume of electronics and hence get lower price for even the low volume segments. So it's an intertwined, let's say, effect on the portfolio. So broadly, automotive, industrial, and EV, they are somewhat moderate in their gross margin expectations at material level. All the other sectors are a little higher.
Understood, sir. Very helpful. Sir, my last question is regarding OSAT/PCB. You did mention in your opening remarks about the state of things right now. The 14 billion QIP proceeds that you have got, will you be utilizing them for deleveraging at all? My first question. And secondly, your guidance going forward, does that include and imply revenues from OSAT at this point in time?
Yeah. So the first question is easy to answer. We raised the funds for specific 2 projects. One is OSAT and the other is high density interconnection PCB, and they will be used for only that. There is a very small delay of a couple of months due to the ongoing elections that have come in. And I think now we are just about a month away from the election process concluding and the model code of conduct going away. So we don't think it's material to do any other, let's say, utilization of that particular thing. And what was the second question, Sonalji? Can you repeat?
So your outlook, your guidance going forward, does that include revenues from OSAT, or rather any upside from OSAT/PCB manufacturing?
Yeah, not in this year. Yeah, this year guidance 60% up is just on EMS and not based on activities in the OSAT and PCB. OSAT and PCB will take 1 to 2 years time to start the initial capacity utilization, and you can see them in full form maybe in a span of about 3 to 5 years.
Understood, sir. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of CA Garvit Goel from Invest Analysis Advisory LLP. Please go ahead.
Hello. Am I audible, sir?
Yes, sir. Please go ahead.
Congrats for a good set of numbers, sir. My first question is on our asset turn. So, can you comment upon the asset turn, the kind of asset turns that we are enjoying? So, what is that basically makes us differentiate from the peers who are comparatively at the lower asset turns, sir?
Yeah. So, asset turns are dependent on the kind of products that you do. And also in the initial stages, we must understand that when the new facility is getting established, for it to improve its efficiency and for it to utilize all the assets that have been implemented, it takes a bit of time. So in terms of asset turns, in our businesses, the high volume businesses will definitely, because of the large batch sizes, will have somewhat higher asset turns compared to the lower volume and high-tech businesses. Having said that, the value throughput in lower volume and high-tech businesses is also higher. So our asset turns are representative of the mix of clients that we have. So supposing the same assets were used to just serve one client, asset turns could be a tad higher. But with a large number of clients who provide us the diversification and who provide us this stability to our portfolio, our asset turns will be somewhere between 7 and 8. They can grow to about 7 and 8 eventually.
And sir, the order book that we are having in hand, so what is the estimated execution period for the same?
Yeah, these represent about 1 year and a quarter year. 1.25 year. They represent business worth
1.25 years, basically.
1.25 years. Some orders are for 5 years, etc., but I'm just giving you an average.
Just a clarification on guidance. Have I heard correctly, like sales growth of 60% for FY25 and a margin improvement of 100 basis points?
Yeah, that's our plan. Yes.
And sir, what is the basic target, like 2 to 3 years down the line, like how the growth momentum is going to sustain? What are the new drivers that will further drive our growth beyond FY25, sir?
We are planning to grow in the similar way with our percentages where automobile will be around 25% and then rest all the ratios will be maintaining more or less in the same way, for which we are focusing on our marketing as well as team building, everything towards the same guidance matter. So that is how we are going to retain the margins at anything between 14.5 to 15 EBITDA.
So this growth momentum is going to be there for at least 3 to 5 years. Is that what you are saying?
Yes. We are very clear. We have put up a 5-year plan and we are very clear and confident that the team will achieve this.
Understood, sir. Thank you very much, sir, and all the best for the future.
Thank you.
Thank you. The next question is from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. I hope you can hear me fine. Maybe just one sort of question to understand your margin guidance. Because you are investing in PCB and OSAT, would that also include any investment impact? Could that impact the margin guidance, or this is inclusive of whatever little investment that we are doing this year as well?
Yeah. So PCB and OSAT business, like I have said earlier, take about 1.5 to 2 years before it becomes operational and starts yielding reasonable capacity utilization. So this year's guidance is completely based on our...
The management line has been dropped. Stay connected until we connect the management back. The management line has been connected.
Yeah, please go ahead for the next question quickly, please.
Mr. Sarpa, just wanted to understand, essentially the margin guidance does not include any, or includes any impact of, investments being done for future growth, like PCB and OSAT, which will not have a negative impact, right? This is a blended margin inclusive of all of this, the 100 basis points improvement that.
Yeah, value acceptable. Yeah.
Sure, sir. Maybe just wanted to understand from a competitive intensity perspective, given that we are growing so fast and we've seen a substantial growth in order book as well. How are you seeing the competitive intensity, especially in segments like automotive, industrials, aerospace? Do you believe that we have a substantial lead over peers, or is the competitive intensity same as it was over the last couple of years?
Yeah. So typically in any industry growth cycle, when the demand far exceeds the supply or installed capacity, in India's case, you can safely take this because we are actually targeting this large amount of imports of electronics, which are high tech and high margin electronics, which is coming into India. We are targeting to do it in India. So there is still a very big demand and supply gap. So competition intensity will be moderated and it will not be deleterious to our acquisition of businesses. And that is what we have seen over the last 6 months, the footfalls that come in. So everybody is getting orders. All the peers probably are also announcing that we have tied this, that, and the other, and we are also getting. So it's our assessment that next 5 to 10 years will be moderate competition intensity. So having said all of that, we still have to be competitive. Obviously, no customer is going to accept anything less than world-class performance, both on quality, cost, and delivery. So we are also very mindful of that. So there is no place for complacence. We have a good quality improvement program, we have a good delivery improvement program, and also a cost reduction program.
Sure, maybe just one final question, given that we are sort of expanding reach into US, how are we looking at export versus domestic mix 2-3 years down the line? Even today, 90% is more towards domestic, given strong growth in the domestic market.
No, can you repeat that? Your voice
is it better now? Just wanted to understand the mix towards exports. How big can exports become 2-3 years down the line in terms of overall revenue contribution? Today, it's up to 10%.
No problem. So exports, let's say in EMS portfolio, especially when it comes to aerospace, defense, and outspace, and it comes to some of the industrial products, exports will pick up. And even in railways, we have now got some clients restarting their export activities with us. So going forward, definitely you will see some increase in the growth in the exports, but still the bulk of the business will be driven by domestic in the EMS sector. However, when we come to something like semiconductor assembly, that is OSAT or PC board, high-GI PC board, they are all export driven, and so another 4 years time you'll see significant increase in the exports to the new businesses. Otherwise, the EMS business by and large will be driven by domestic trends and tailwinds in the domestic market.
Sure, sir. Thanks for all your answers and best of luck for future quarters.
Thank you, Deepak. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, good afternoon. Thank you for the opportunity. My first question is on your medium-term aspiration. If I recall correctly, you had an aspiration of getting to $1 billion revenue by FY28, of which 75% is EMS and 25% is other businesses. Does that timeline still hold, or because of the current delays, we could see a year or a couple of years of slippages in that?
We are very confident that we will be achieving this number in year 2028 because the tailwinds are very good and the entire globe is looking at India. And when they look at India for manufacturing, electronics is the first preference. So we are very confident that we will be able to achieve this.
So when we get to this number, our margins will be materially better than this, right? Because PCB manufacturing and OSAT is significantly better margin business than EMS globally. So do you think that the margins could trend up even more from the current level?
No, at this point in time, we maintain that it will be retained at our current thesis level, which is like we are saying that around 15+% EBITDA and 10+% PAT. Yeah, once we establish the high-tech advanced packaging businesses, etc., yeah, there is a possibility to take the margins up further in those segments of the business.
Sure. My last question is on the bareboard manufacturing. Is that also hinging on government approvals, or that is independent of that, and we can start some bit of bareboard manufacturing this year?
We have got approval for that already. We are in the advanced stages of finalizing the orders with all the suppliers. Recruitments are going on, and construction is also just starting.
So we can see some shipments this year on this?
Yeah, we will definitely see some shipments this year.
Sure. Thank you and all the best.
Thank you, Daljit.
Thank you. The next question is from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thank you for the opportunity. Congratulations to the team for good results. Sir, two questions. First, on just bookkeeping one. Q4 other expenses at around 31 crore is almost flat Q on Q and lower year over year despite very sharp increase in revenue. So, is there any one-off in this quarter or any one-off in the previous quarters, either last quarter or last quarter same year, as last year same quarter? So, I mean, and just related question. Just to complete the related question is that in the backdrop of this increased capacity in EMS business itself and for the new businesses that is PCB and OSAT, what kind of run rate should we assume, say, in FY25? So these are stable numbers, or we should assume some increase in FY25? How do you think about it?
Sure. I'll answer the second question first. That's a bigger one. So that as far as the EMS growth is concerned, this was something that we had internally always imagined that will happen. And we always saw a strong tailwind. If you remember all the meetings and all the discussions, we always talk about this huge amount of import of these things getting done in India. So that story of 50, 60%, 40, 50, 60% growth rate will continue for quite some time to come. And as far as the OSAT and PCB, high density PCB is concerned, this is in line with our expectation to become an integrated player. So as we grow the EMS business, this also becomes important to have our capability here, because there will be many clients who require us to do all the three activities. That is high density interconnection PCB, also make modules and high-end packaging silicon assembly for them. And then of course they want us to do EMS also. So we have already seen some customers in this horizon. So as we see, whatever are the expectations, it probably is going to get better than that going forward in the future. Now on the other expenses activity, I think this has something to do with classification and not anything to do with any expense increasing. So going forward, it will be similar to what we have seen in the other expenses in terms of percentages. You can take that. So there is no one-time expense. There is just it's a categorization thing. We can probably explain to you later too, in detail. We'll be publishing the schedules and all that, so we'll get into that.
Yeah, basically, year-over-year degrowth in other expenses and revenues growing. So, current quarter's numbers are sustainable, 130 at around 30 crore. There is no one-off, and adjusted for it, the number should be higher, nothing like it.
Yeah, the current quarter numbers in terms of expenses are certainly sustainable. And in fact, like we have said before also, there is some more operating leverage possible in our business. If you notice, at 15% EBITDA, we have 15 to 18, 19% of cost, and they can always be leveraged with higher turnover. Of course, some part of them will be fixed and or which can be leveraged, and some part of it is variable, which will be leveraged after scaling up. And so you can safely assume that these cost profiles will not adversely change. If at all, there will be improvements.
Understood. Second question on factoring. So, what is the number of, say, receivable discounting or factoring for FY24 versus FY23? If you can give that number.
Sorry, can you repeat that question?
The quantum of factoring or receivable discounting that we have done for FY24 and the same number for 23.
Yeah, we can get that data out, but factoring essentially is to customer recourse. So many customers prefer to use their financing agents, and then what they have is they have an arrangement with their factoring companies to fund if at all they have a need for credit. So from our side, we prefer factoring because that rid us of this burden of collecting and then follow up, etc., which also is a problem in relationship management with this thing. So we prefer this, but that's all the large customers. It suffices to say that all large customers would like to enter this route.
Okay, no worries. Sir, thanks a lot and all the very best. Thank you.
Yeah, thank you, Kaynes. Thank you.
Thank you. The next question is from the line of Vipral Srivastava from InCred Research. Please go ahead.
Hi, I'm audible, right?
Yes, sir.
Yeah. You just had one question, two questions. So first of all, regarding a low volume business, so wanted to understand that what is the right to win for Kaynes here? I mean, can your competitors undercut you on price? I mean, the only differentiator here is price, right? So is that a possible scenario in future? Can that happen, or that's not the case?
Yeah. So what is the basis of competition? So like we have to go back to our portfolio. Our portfolio is those of customers. So we are a high involvement supplier. That means all the products that we do, customers most of the time will come and sit with us and help us develop that production, etc. Whether it's automotive, whether it's EV, it's industrial, aerospace, defense, whether it is medical. So we are a high involvement supplier, and that by definition means that the relationship is not dependent on price. It is dependent on what we deliver in terms of ability to do complex products, ability to do critical products, ability to meet their quality requirements, and ability to turn every one of their requests into an opportunity for us. Having said that, every buyer has an aspiration to to match the value delivered to the price paid. So we also are aware of that. So we don't become complacent in this area. We always have a cost reduction program, both fixed costs, that is manufacturing costs, establishment costs, and all of those. Plus, we also have a very strong program to work on raw material costs. So let me put it this way: the price is what market can pay, and margin is what we can make.
Right. Fair enough. Second question on the gross margin. So just wanted to understand. So you expect, so since you're guiding 100 basis of margin improvement, that will flow from gross margins or from operating leverage?
Yeah, so the numbers are clear. Obviously, the gross margins have come a tad down, so we have done operating leverage. And like I said, we still have a fair amount of operating leverage possibility because we still have a middle line which can be leveraged better. So simple answer, we have done operating leverage, we can do more.
Okay, and your gross margins will remain at this level only, right? Or it will also improve?
Yeah, so gross margin is a function of the blended gross margin, right? So it's a function of where you get the order. So obviously this year in FY2025, we expect more from the high margin, low volume, high tech product category. So that way move up a little, yeah.
Okay, and last question. So your OSAT partner, Globetronics, they're facing some issues currently. So the Apple contract has been cancelled and the stock price has also taken a hit. So does that impact you in some way, or how do you look at it?
Yeah, so Vikram, see, the issue is once we get the government approvals, we have several partnerships lined up and there are several backup also available. None of these can be consummated till we get the government's approval for the subsidy scheme, correct? So there is nothing cancelled, etc. We are in touch with everybody. So yeah, so there are people going for training and so on and so forth. The only thing is you will not see a factory coming up and production start till that happens. That will happen in June.
Okay.
And so there is no tension from that aspect. It is just that it's taking a couple of months more than what we anticipated.
And whatever knowledge we are having, we have no cancellation from any of our partners or anything. All agreements are intact.
Okay. No, Globetronics lost their main client. They are an Apple company, so Apple cancelled their contract. But yeah, I just wanted to confirm that. Thank you. Thanks a lot.
Thank you. The next question is from the line of Amber Singhania from Nippon India AMC. Please go ahead.
Yeah, hi, sir. First of all, congratulations for the great set of numbers. Yeah, am I audible?
Yes, sir.
Yeah. So there are two questions from my side. Is one on the order book side, we have recently announced orders coming in from for servers as well as smart meters. So could you help us with the size of these orders and what could be the run rate going forward? I believe the servers order are the starting orders and or the token orders later on it can expand significantly. So sustainably, what kind of size we can expect in terms of ordering inflow on an annual basis from both smart meter as well as CDEC? That's my first question.
Sure. So you're right. These orders are expected to repeat over the next several years because the demand-supply gap is pretty high in these. So as far as smart meters are concerned, these orders can get as high as 400, 500, 600 crores per annum. And this will continue for the next several years. I am talking about a conservative estimate. And as far as feedback order is concerned, of course, in the public domain, but let's say about 200, 300 crores every year we will do. And in that category of high-performance computing servers, we have several other global players and Indian players with whom we are closely working. So that is also likely to add some quantum of business to us. So roughly at a mature level, practical level, the high-performance computing can be anywhere between 300 and 500 crores per annum. Smart meters on a steady state will exceed definitely 500 crores per annum, maybe more.
And these CDEC orders are also the similar margin, right?
So these smart meter orders are actually not part of your 4,152 crores. Smart meter orders have been concluded, especially the large orders have been concluded in April and May. So in the next quarter, we will add these orders and show you. So CDEC order is already part of our order book and some more will come in.
So sir, what would be the current order book adding these info?
Sorry, I am not able to hear you, Amber.
Okay. And sir, secondly, one clarification on the guidance part, which you mentioned, 50-60% kind of growth on this year's number or revenue, whereas the order book of 4,100 crore is executable over a period of 5 quarters. So based on order book, it is around 3,300 odd crore, and based on the 50-60% growth, it is 2,800 odd crore. So if you can just help us understand the guidance.
Yeah. So obviously, our target is a moving target, right? We keep on getting more orders and we try and make capacities available. So it's our assessment that at least 60% growth should be there for at the minimum if you have to satisfy the customer's requirements. Because just having the order and not executing also is not a great thing. So that is the basis on which we are saying 60+% of growth. And we will update you once we do 2 quarters. If the first half is over, then there will be an actual on board, and then we will also have all the impending orders coming in. So we can talk about that. But it's on the upswing and it's quite, let's say, quite doable and quite certain. Yeah.
Got it. Thanks a lot, sir, and all the best for the future. And again, congratulations for the great set of numbers. Thank you.
Thank you, Ambarji. Thank you so much.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. Can you talk about opportunity in aerospace, defense, and railways for you?
Sure. So in railways, we were earlier a major player only in the electronic interlocking. So now we have started developing for the train collision avoidance system, namely the Kavach program. We've also got several RFQs, and we are in the process of finalizing contracts for onboard electronics. These are electronics which are fitted onto locomotives, and these are electronics which are fitted onto carriages. And then there are other track-related things, etc., where there is a lot of work going on. So in railway, we now are in line to do electronics for both the programs. One is the safety improvement program. The other is the signal expansion program. And third program also, which is the improvement of carriages, like Vande Bharat and other trains. So this is a little longish term, let's say, activity. We are also doing one more thing. There are some legacy products which are used by railways. So we also developed some of those things easily. And then we can fulfill some of those contracts too, because they also fall right in the area of work for us. So as far as railway is concerned, we are now enriching our product portfolio and also taking advantage of whatever growth that is coming in. The second question is defense, aerospace, etc. So there we focus currently on avionics, and I think that itself will keep us busy for some time now, because there's a large customer and then we are having a very close relationship with the customer. It's a 10-year program. So we think that as far as aerospace is concerned, that will be majority of our business to begin with. So there are other things like outer space. We are a strategic supplier to the Indian Space Research Organization, as well as there are some external inquiries coming in because of our work with the Indian entity. So outer space is another thing which is going to go in a big way. So these are the some little more color on these two sectors. And medical is the other sector where we have got a very large client with critical care equipment. Both Europe as well as US based orders are there for the same client. This client has recently acquired one of the largest medical equipment manufacturers in the US too. So we are going to get benefited from this association over the next several years.
So in last 2 years, we have seen a degrowth in medical segment. So can we expect a growth in this segment going ahead?
Yeah. So this year we will see at least medical segment will go with triple digits. At least 100 crores plus will be there in the medical sector in FY25 for sure. Because we have a reasonably good. I understand. The last 2 years we've been expecting this to happen, but it takes long time to approve products. We have also said no. It takes typically 1 year to 3 years for any customer to approve us, and especially in critical care products, it takes even longer time. So this year we'll see a triple-digit medical number, probably a little more also.
Okay. Thank you so much.
Thank you. The next question is from the line of Nitin Sharma from MC Pro Research. Please go ahead.
Yeah, hi, thank you. So, where do you see your net working capital days by end of FY25?
FY25, is it?
Yes, yes.
Yeah, so FY24 we have brought it down to about 83 days. So our ambition is to take it to 70 days, and then we have to do some improvement in some other technologies that we are using, digitization and all that. So we also believe internally that just because we are working in low volume, high mix segment, it need not be high. So we have come to a realization that we can drop this net working capital days further. So FY25 may come to around 70-72 days. Yeah.
Understood. Secondly, I want to understand, is there a scope for a delay in the OSAT approval more than where you are seeing? I hope not, but is there scope for further delay there? What is driving optimism?
Yeah, so see the OSAT delay that Amici pointed out in his initial comments and later on too. See, it is a matter of crashing the schedule by about 2.5 months, which we have already provided for. When we originally discussed about the project schedules, we already added a buffer. So we'll have to release those buffers, and also in the meanwhile, we have kept everything ready, including suppliers have been primed and so on. So it's like the moment this approval thing happens, then all the other actions can happen quickly. So acquisition of people and processes and talking to people, etc., talking to collaborators, all that is going at a regular pace only. So I think eventually it will not affect the schedule of delivery too much.
Understood. Thank you. I wish you all the best for FY24.
Thank you. The next question is from the line of Neil Mehta from Equirus Securities. Please go ahead. Neil, you can go ahead. Participant got disconnected. The next question is from the line of Karan Sanwal from Nivesha Investment Advisor. Please go ahead.
Hello, am I audible?
Yes, sir.
Yeah. Thank you for the opportunity and congratulations for the brilliant set of numbers. Wanted to understand which sector would have driven the growth for the industrial and EV segment in the FY24 because we see a jump in the contribution in the overall revenue.
You wanted to get some more insights into the industrial and EV segment.
Yes. Yeah.
Sure. So industrial and EV segment is a key segment for us. It's also a very widely distributed segment. It has things like energy meters, it has things like instrumentation, it has things like power electronics, it has things like switchgear. And EV has got two-wheeler EV, four-wheeler EV. We are also having off-highway vehicles like golf carts and things like that. And then we are having EV charging infrastructure. And we are having certain clients, of course, in the EV component space. So it's a cumulative effect of all of these. So EV, of course, has grown because earlier there was no electric vehicle production in India. So that has grown. So that's a significant growth driver. And in the industrial, it's a combination of all. But going forward, what is relevant to us, I think, is that the smart meter numbers will go up. And also the power electronics numbers will go up because these two clients have indicated to us a higher forecast. So these are the three, EV, all of the sectors are going up, two-wheeler, three-wheeler, four-wheeler components and infrastructure. And in the other industrial, smart meters and power electronics, these are the two sectors which are showing strong improvement. And in the export segment, we are having instrumentation also taking up its own traction.
Okay, that was very helpful. And wanted to understand, like you highlighted the growth in smart meter contracts. So what will be the proportion of, the cost that would be helping the clients? Say, for example, the client is making a smart meter. So what would be our contribution to the overall cost to those smart meters?
Yeah, see, smart meter, the entire profitability and all the good part of the business is completely dependent on demand-supply gap, right? So if there is more supply and less demand, always there is cost pressures. And if there are more demand than suppliers, then there are margin reliefs. So today, smart meter, because of the government's insistence on going from the older regime of electric, and electromechanical meters to smart meters, is driving the demand much higher than what is the capacity. There is just hardly 3-4 major players who are actually into this area. So we don't expect any major undue margin pressures due to our foray into this activity. And also this is a rich segment. There are not just meters which go to people's homes. There are other equipment, especially in the electrical distribution sector, wherein we have also got inquiries from a lot of companies. And so that is also, and those are all typically lower in volume, but they are also complex products. So all in all, this metering segment, especially when with the new generation of smart metering, is a good segment to be in.
Okay, and one last question, like, would it be okay to name the clients of Kavach, the TCAS system and the smart meter?
So Kavach client is Government of India, and I'm not at liberty to disclose without getting consent from them. But this is in the public domain, so you can find out. It's not very difficult to find out.
Okay, no problem. No, thank you so much, and all the very best.
Thank you, Mr. Agarwal.
Thank you. Since we are heading towards timeline, this can be the last question. We will address the other questions offline. I now hand the conference over to the management for closing comments.
Yeah. So thank you, everyone. We had a very enriching session here, and all these questions are quite deep, and we have noted down all of these questions, and we will take appropriate action and also share this information internally. And if anybody wants any information, they can always reach out to us, and then so whatever is possible to share, certainly we will be able to share in terms of additional insights, additional view of the markets, etc. Thank you very much for taking your time and encouraging us in this journey to make Kaynes Technology a great company.
Thank you.
Thank you. On behalf of JM Financial Security Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.